A billion-dollar buy order instantly consumes every seller on the current ledger. This sudden vacuum of supply creates massive slippage, forcing the price to rocket upward before the order is even partially filled. Executing these massive block orders on a public exchange is self-defeating. By aggressively chasing the available liquidity, institutions drive the market against themselves, destroying their own entry or exit prices through sheer volume displacement. This is the primary mechanical constraint for the hedge funds and banks that control the market's true volume. They possess the capital to move the needle, but they lack the liquidity to do it without being noticed. Institutional traders utilize the market cycle as a mechanical solution to this problem, engineering specific price environments to source the necessary liquidity from retail emotion. To navigate liquidity requirements, institutions move capital through 4 phases: accumulation, ascending, distribution, and descending. This engine relies on dark pools and algorithmic routing, chopping massive trades into undetectable fragments. While price action is hidden, underlying volume data reveals institutional signatures at exact turning points. The objective is to isolate these technical markers so you can separate the noisy, emotional trades of the public from the data-driven reality of the institutions. Accumulation begins when the public is in a state of maximum despair. Following a significant sell-off, retail sentiment is paralyzed by the fear of further declines. Institutions use these dark pool networks to quietly absorb this wave of retail panic. By buying in the shadows, they satisfy massive liquidity requirements without triggering a premature price recovery. This stage leaves a distinct structural marker on the chart, the Wyckoff's ring. The price trades in a tight, flat range, dipping briefly to test lower levels before recovering into the base, signaling that the selling pressure is finally exhausted. We confirm this accumulation through bullish divergence. While the price remains flat or slightly lower, the relative strength index begins to slope upward. This rising momentum proves that smart money is aggressively absorbing the supply. Consider Nvidia in 2022. During months of flat consolidation, the public trading volume hit multi-year lows. This lack of activity masked the massive institutional positions being built before the subsequent AI-driven expansion. Accumulation allows institutions to build significant positions precisely when the public is too discouraged to participate. Once the accumulation is complete, the institutions step back and allow high-frequency algorithms to breach the established resistance ceiling. This breakout forces short sellers to buy back their positions while simultaneously triggering a wave of retail FOMO. This influx of public buying pressure provides the momentum the algorithms need to mark up the price. The primary evidence for this phase is a vertical volume spike occurring exactly at the point of the breakout. This volume surge confirms that the move is supported by institutional capital rather than retail noise. During the markup, algorithms utilize continuation patterns like the cup and handle as calculated resting periods. The price dips into a rounded base and consolidates briefly before the next move higher. You will also see bull flags, short downward-sloping channels that allow the algorithms to scale into larger positions before initiating the next leg of the rally. The ascending phase uses retail euphoria to inflate the value of the shares smart money bought during the period of panic. An institutional position is only as valuable as the exit liquidity available to close it. If a fund attempts to dump its entire holding at once, the resulting price crash destroys their profit margin. To exit their positions, institutions often manufacture a false breakout. They push the price slightly above a major resistance level to trigger automated retail buy signals, creating a temporary surge of buying interest they can sell into. The technical warning for this trap is bearish divergence. While the price reaches a new high, the MACD and RSI indicators trend lower. This shows that while the price looks strong on the surface, the actual buying power is being exhausted. Look closely at the candlesticks forming at the resistance level. Patterns like the doji and the evening star are characterized by long upper wicks, showing that every attempt to push the price higher is being met by aggressive institutional selling. These wicks visually represent the institution capping the price, using the peak retail demand to offload their risk without crashing the market. This mechanical trap occurred at Meta's peak in late 2021. As the stock traded near $380, the RSI flashed a clear bearish divergence, signaling that institutions were exiting their positions while the public was still buying the rally. Distribution is the ultimate liquidity trap, using a positive news cycle to transfer institutional risk onto the public. Once the massive institutions have fully exited, the underlying algorithmic buying support completely disappears. The market structure collapses. High-frequency algorithms detect the breach of support levels and pivot to aggressive sell programs, intensifying the downward momentum. In this phase, we look for bearish continuation patterns like the descending triangle. The price forms lower highs against a flat floor until the support breaks, leading to a violent high-volume drop. A common error here is buying the dip because the RSI is under 30. But without a bullish divergence, an oversold RSI simply confirms that the downward momentum is still in control. The descending phase forces the final retail capitulation, clearing the ledger so the accumulation cycle can begin again. This cycle is a closed loop. The descending phase links directly into the quiet base of a new accumulation. Price action alone is a deceptive public narrative. To see the market clearly, you must overlay institutional data, volume anomalies, and momentum divergences. Confirmation of any trend requires correlating these technical signatures. Without volume support and momentum alignment, price movement is merely retail noise. Effective trading isn't about predicting what the market will do next. It's about stalking the institutions and identifying their entry and exit points. Wealth is generated by identifying these institutional signatures and mechanically aligning your capital with the smart money that drives the cycle.